Wow, now this is a big U-turn. There's this investment bank that's pretty well known on Wall Street, and they have a new call that I think is worth analyzing some details to. But rather than only give this perspective, what I'm going to do is I'm going to give you this perspective, but then I'm going to balance it with the opposite point of view from another investment bank. So that way we can kind of try to see, okay, who's got some arguments here? Let's take a look at this because some of the takeaways here are absolutely phenomenally interesting for what's going on in the market and what to expect going forward. Beyond, of course, now a Halloween trick-or-treat, hashtag treat, coupon code link down below on the programs on Building Your Wealth. Of course, you've got the Stamina Potion. You got to take advantage of the programs on Building Your Wealth. And join me in those live streams where I break down earnings for you. If you miss earnings with Meet Kevin, you want to be part of those live streams every single day when we break down earnings, because we actually go into the reports. It's not just reading the numbers. We read the reports. And you don't have to do anything. You just listen. It's kind of really convenient. So check out those programs linked down below. All right, folks. Whoo, boy. Take a look at this particular report over here. This one is a little overwhelming when you first look at it, but don't worry, I'm going to break it down for you. So first of all, their first argument is that the Fed has really rushed to raise rates. They call this the Fed being in a hurry. And in their view, what they find is when the Treasury yields increase, the S&P 500 price to earnings multiple decreases. And remember, when we see a decrease in multiples, when we see multiple compression, we obviously tend to see the S&P 500 fall. And so what they argue here is that as long as the Fed stays the course of hitting this sort of peak level of tightness and they don't get tighter than the level of tightness that they're at now, then peak real yields may already have been achieved, which means the only direction would be down. And when treasury yields, real treasury yields go down, price to earnings ratios go up for the S&P 500. And this is actually bullish for stocks, and they'll tell you exactly which stocks as well in just a moment. But to reiterate their argument in terms of why they're making this call now, they say that you shouldn't fight history. Fighting history is like fighting the Fed. And over the last 60 years, the S&P 500 has returned almost nothing, absolutely nothing, between May and October. Wait a minute, how is that possible? Because over the last 60 years, the S&P 500 has always been sort of returning somewhere between 7 to 10%. How could it return zero between May and October? Well, that's because they argue that between November and April is actually when you get most, if not all, of your cumulative returns. In fact, they have a chart that breaks this down for you. Take a look at this. If you invested only in the periods between May 1st to October 1st, your returns on an original $100 investment from 1962 to today, 2022, would literally grow from about $100 to $118. That's it. And if you only invested between November 1st and April 30th, you would essentially be over here at the green line. And then actually being fully invested outperformed. Look at that, fully invested, always outperforming. No surprise here. Generally, time in the market beats a timing the market. Now, I'm just gonna make a quick side note there because some people are like, yeah, but Kevin, you try to time the market. Dude, I saved a lot of money getting out of stocks that would have done terribly in a recession. You have to reallocate your portfolio, okay? That doesn't mean you're trying to time the market. It just means you're repositioning to prepare, and then you diamond hand through whatever pain you set yourself up for. But anyway, really incredible chart here. So when we go back to this sort of denseness of what they try to tell us, they say that basically, hey, look, once the markets realize, oh man, we might actually be at peak yields, then people might rush to buy treasuries. Now, I don't know if we're actually going to see that just yet personally, because there's a lot of talk that peak yield might actually be 5% for the 10-year treasury. But I'll tell you, today, bonds are rallying, which actually means yields are falling. take a look at the 10-year today sitting at 4.125, falling off of its 4.25 level, seeing sort of potentially, at least intraday, this sort of bouncing off of these highs again, or getting rejected by these high yields again. And essentially, some say starting to price in peak yields. Again, many say no, peak yields are when these hit 5%, but going back to the argument of this bullishness, and remember, we're going to balance this with some counter arguments here in just a moment as well. They argue in this report that CPI, that is consumer price index inflation, right, has essentially only been 2% on an annualized rate over the last 3 months. Now, really what they're doing here is they're taking the actual number of CPI, and they're kind of taking this little chart that we've had that looks something like this, where we kind of hit a peak and we've kind of been bouncing down. Well, when you take that sort of average, fine, you could say we only have a 2% annualized rate of inflation, but look, nobody even believes that as far as you could throw it right now, because we've seen too much broad-based inflation spreading to too many different sticky areas, especially rental and housing inflation, and services like healthcare, which really aren't expected to peak until probably sometime early to mid next year. But they go on to argue anyway that, you know what, we've got an employment cost index report coming out here on the 28th. That's just in a few days, folks. That's in 3 days. And that is going to be a critical moment for determining, hey, are wages escaping in the pattern of a wage price spiral, or are we actually at peak inflation, peak yields, peak quit rates, which means you no longer have people saying, oh, I'm going to quit my job because I can get more pay at a different job. Instead, people are staying put. So you see quit rates come down, which actually reduces inflation, right? All of these arguments are that, oh, inflation will come down. And eventually they suggest that, yes, sure, there's a lag in shelter inflation, but maybe we'll see that peak about 9 months later. They argue that quits peaked in December of 2021. They don't give us an idea as to when they think shelter may have peaked. I personally think shelter and rents peaked somewhere around May and June for rental prices. But they make this argument that we'll probably see the actual recession, where even Joe Biden's like, yep, we're in a recession now in the third quarter of 2023. But they actually think the bottom of the market could be now, and that in the near term, the S&P 500 actually has the potential of hitting a peak before we get into an official recession, even though, come on, you and I know we're already in a recession, right? 2 quarters of negative GDP, that's all I need to know. Okay, this sucks. I don't need the NBER to tell me what a recession is. I don't need Joe Biden in the White House to redefine what a recession is. We're in a recession, okay? And that's okay. But take a look at this argument. They argue that the S&P 500 could actually rally to 4,300 from the about 3,800 where it is now. That'd be about a 13% boost, peaking in April of 2023. And they think for the rest of the decade, we actually think that we could see earnings per share double over the next decade. However, price to earnings ratios will be cut in half. So we're just not going to see that sort of rich, overvalued, bubbly, stimulative valuation anymore for the market. But because of earnings doubling, we'll actually still see some decent returns investing in the S&P 500 between now and the end of the decade, which is obviously very, very motivating for potentially buying the dip. Now, they do say a risk factor here could be rallies in commodities. If we're in a secular bull market for commodities, basically higher highs and higher lows for commodities over the next 10 years, that's going to hurt us a little bit. But if we do have commodities rally, value might be what you want to invest in if commodities do well. Value would be things like energy plays, utility plays, banks, real estate, autos, not including growth autos like Tesla. That's more of a growth and cyclical stock. Procter & Gamble might be another style of value. But if commodities actually come down, we could actually see growth outperform. So it really sort of dependent on what we see happen. Now, one of the things that they point out is that we still have not seen the inversion of the 10-year 3-month curve, and they think this is going to happen by January, signaling that we'll actually have a recession in September. That's what they believe. But they also believe that this recession will be very, very similar to World War II, where we spent a lot of inflationary money on World War II, right here, this green chart and the spike, which matches sort of the COVID war spending, which led to this delay. You could see sort of this gap over here, this gap in peaks over here between the green line, which is spending, and blue line, which is inflation. And this being sort of your peak reopening inflation. And then what happened after the war? Boom, inflation just plummeted. And that's actually the trajectory that we're on right now. Now I'm gonna give a little bit of my own kind of counter argument to this and just say that, hey, look, the 5-year break-even rate, which is something that I generally watch for a decline in inflation, has been trending down substantially, okay? Very, very clear evidence that we're expecting inflation to come down. But I'll tell you, in the last week or so, maybe even 3 weeks here, it's really been coming back to life. I was really hoping for more of a sustained downtrend. Now, we do tend to have these sorts of moves back up, so that does happen with break-evens, but it's something we want to pay attention to because the Fed watches this, and if this continues to spike up, especially if we get to that dreaded 3.0 number again, the Fed's going to have to go dirty on us again. So, very, very optimistic here from this company. Now, I do want to talk about a flip side argument and some projections. So we're going to pull up some projections here from a flip side argument. Now, the flip side argument comes to you from Barclays. Okay, this isn't an ad from Barclays or whatever. It's just a flip side argument from this other investment bank that we've been looking at. What is an ad is the coupon link down below for the programs on building your wealth, or life insurance you can get in 5 minutes by going to metkevin.com/life, or 12 free stocks that you can get with Webull by going to metkevin.com/Webull. Any of those, metkevin.com/join for the courses, life for life insurance, or Webull for Webull. Those are what are sponsoring this video and keep me in business so I can buy other YouTubers merchandise like Bread Boys. Shout out to them. Anyway, okay, so what does Barclays think? Okay, well, so here's Barclays. Barclays says, no. The data is not actually suggesting that we're having any kind of meaningful decline yet in the labor market or inflation. And it is way too early to suggest that, oh, things are absolutely game on to be bullish. In fact, they go in and say here that economic data has been surprising to the upside. Initial jobless claims have fallen recently, which is the opposite of what a slowing economy would suggest. Quite frankly, earnings have been coming in pretty damn decently. Coca-Cola beats, UPS maintains guidance, right? We're actually still seeing strong earnings come in, with the exception of some companies that just suck. Like, well, okay, I'm not gonna mention them, but just Snap. Anyway. Probably Facebook too. Oh gosh, I shouldn't have said it. Anyway, job postings on the private platform Indeed have risen recently. Indeed. How crazy is that? We're expecting to see less job openings, yet we're getting more job openings according to Indeed. At the same time, less people are filing for unemployment, which is just a sign that we potentially could still see a wage price spiral come, which is a dirty rug pull that we will then get from the Federal Reserve, or which precedes a dirty rug pull that you'll get from the Fed. They will never stand for a wage price spiral. I've been talking about that since January. I sat with a Federal Reserve, somebody who used to work for the Federal Reserve, and I told him, dude, I'm worried. He works at JP Morgan now. I'm like, dude, I'm worried about a wage price spiral back in January. And he's like, nah. And now we're talking about it again. And it's like, yeah, worst thing that could happen, wage price spiral. And look at this. This right here, I don't know. That doesn't make me very enthusiastic here. Initial claims, I'm gonna cross that one off. I think this fluctuates so much week to week, doesn't so much matter. This job postings thing on Indeed, that's interesting. I want to start paying attention to what Indeed is up to. But, they make this argument here that, look, investors are getting overexcited about this idea of a Fed pivot coming. And really, here are kind of the following scenarios that you have for 2022. We've got 3 scenarios here: a bull case, which is a soft landing, shallow recession, and normal recession, being the bear case. And they believe that in 2022, we basically still have straight up downside. Even in like the soft landing, we're still down 10%, and in the hard landing, we're down 20%, with 14.6% in between. They do believe that for 2023, in the soft landing scenario, we could see a 12% upside, but that's balanced off by an over 16.5% downside to the S&P 500 next year, in the event of a real recession where we do continue to see earnings actually collapse. One of the big problems we face now is we keep expecting that earnings are going to collapse, but they're just not yet. And so we kind of keep kicking the can down the road. It's like, oh, well, eventually earnings will collapse, right? And then it's like, okay, well, it wasn't Q1, it wasn't Q2, and now it's kind of like, is it going to be Q3? Maybe not. So we kind of just keep kicking the can down the road. It's like, okay, well, when are we actually going to get the recession? And that's where you do have, some folks on one side of the argument saying, well, by the time companies are actually ready to be in a recession and consumers are like, okay, yeah, I'm officially out of money, maybe inflation will have started coming down. Now, that could just be the rosy hopium scenario where it's like, oh yeah, as soon as people run out of money, all of a sudden we just won't happen to have any inflation anymore, and that'll happen right after the election too. Okay, whatever. Anyway, there's a whole lot of cynicism that we could have towards the market. The reality is, look, inflation's either going to go down or it's not. If inflation goes down, you get all in on this market. You go long growth. Not financial advice. I am a financial advisor, but I can't give you financial advice because I can't provide generic or impersonal financial advice on a YouTube video. And so we're not doing that here, but we just want to be very clear. Like, obviously, if we start meaningfully seeing inflation come down, you kind of want to move along quickly. In the meantime, you haven't been getting punished sitting in cash and waiting on the sidelines, as painful as that is to say. And there are a lot of FOMO folks who are saying, no, you got to be in, but you got to be careful because FOMO can hurt when it turns into, well, sadness. Yeah, forget fear. It just turns into sadness and regret. Romo. Regret of having gotten in. Whatever. Anyway, I don't know, folks. What do you think? Whom do you agree with? Do you agree with the first argument that, hey, we've got some bullishness coming up and we're basically at peak yields? As long as the Fed doesn't have to get more aggressive to fight a wage price spiral, we should be on the up because history says October to April is game time. This is where sell in May, go away comes from after all, right? Or do you think Barclays is more correct? That, hey, like, whoa, not so fast. Still not actually seeing the data the Fed's looking for. Whew. Let me know what you think. Make sure to also check out the links down below. Remember, metkevin.com/life for life insurance, metkevin.com/Weeble for Weeble, 12 free stocks, and of course, metkevin.com/join for the programs and that trick or treat coupon code linked down below. Take advantage of that before Halloween.